Before I introduce everyone, just a little bit context on what we're going to try to do here in this panel. I used to work at Bain Capital. This was in Boston. And Boston is a very sports-hungry town. And there was a friend of mine who was a hardcore ice hockey fan. And actually the first deal I worked on was to buy the National Hockey League. So I also got interested. And there's a gentleman called Wayne Gretzky, who's sort of like the Tendulkar of ice hockey. And he always used to say that his father used to tell him, don't chase or go after where the puck is, but go after where the puck is going to go. And in a way, investing is a little bit like that. One day you can wake up and you find that the IT company you were following was, a total fraud, or the government wakes up and passes some retroactive tax. So it's difficult. And in that context, I don't think we can have a better panel than we have today. And the aim is that I'll at least try on your behalf to try to get into the minds of these guys who've done this over many, many years and help us frame how they think of investing in India and how do they counter a market like we are seeing today. So first, starting from the right, we have Nilesh Shah, who's really doesn't need any introduction. He came here last year as well, and somehow we've conned him into coming back this year again. He heads Axis Bank and has been investing across equity, fixed income, done an investment banking over the last several years. Next is Amol, who's like me, a private equity guy, but spent time in Merrill and then TPG, and is now actually founding his own firm. Then I have Sridhar, who's from Morgan Stanley, is the managing director there, looks after large cap equity, again, prolific investor for many, many years. Then we have Avinash, who sort of represents, he lives in London, he's come here just for this conference, and works at Jupiter Management, which is a very well-regarded fund. And then there's finally Birla, who looks after Birla Sun Life, which is one of the largest mutual funds in the country, upwards of 100,000 crores. That's the panel. To get going, I think the question all of us have is, the market is up 30-40% this year, and in this sort of market, how do you manage to invest in this sort of market? Because at one side everything is looking very expensive, and then you're worried about geopolitical risk, you're worried about whether all the promises will actually fructify. So maybe I'll start with Nilesh. When you look at a market like this, do you change the way you invest? Do you change the way you evaluate companies? And how important are the experiences of the last several cycles which you've seen when you think about investing in such a market?
So investing is very, very simple and commonsensical. It doesn't change with the market cycle, it doesn't change with companies, it doesn't change with the sectors. Essentially, if we see the growth investors versus value investors, eventually the consensus truth is that growth without value is useless and value without growth is useless. So no matter where the market is, all you have to find out is companies which are available at reasonable price, which are available at a price or a performance which is going to be more than what market is discounting. And if you can do that consistently, irrespective of market cycle, you will get your winners. In 2008, market was at top. By 2010-11, markets had come down dramatically. But within that, you could find a large cap company like TCS, which went up 5-6 times. So even at the peak bull run of 2008, you could still invest in a large cap company like TCS as much money as you had, and you would have gone up 5 or 6 times, whereas the index would have become half. So no matter where market is, no matter where cycle is, if you can pick up good company, you'll always make money.
Right. But that's, I know you can pick the TCSs of the world, etc., and there could be select examples, but on a consistent basis, do you have to, worry a little bit more? Do you have to do deeper analysis? Does something change in the way you do your day-to-day activities?
So because
the margin of safety, which we all learn about in business school, so theoretically at least goes away, right?
So stock investment is not like a science, it's an art. And there are no defined rules of success from a scientific basis. But certainly there are defined rules of success from an art basis. So if I take this class back maybe 10, 15 years, and then ask them to invest on just two simple commonsensical things, which even my mother or my daughter can answer, that I'll invest in company which will remain in existence after 10 years, and I can visualize today that they'll make more money 10 years down the line than they are making today. Just two simple commonsensical questions. I'm sure anyone can answer them with conviction. And then you start visualizing your investment philosophy.
Let me get you in, Sridhar. Do you, look at least what's happened with the stock market versus, what has fundamentally happened in the companies? There's somewhat of a dichotomy at the moment where, earnings have not really gone up. There's no change in the way the companies are performing. Yet we've seen the prices go up 30, 40%, in some cases 50, 60% in some sectors.
Yeah, so typically at a turn of a cycle, the valuations always look expensive because one, it's an occupational hazard that the analysts cannot project what will happen next year when a cycle turns. A classical example is what's happening right now. We're at the bottom of the cycle. If you look at the capacity utilization of most of the companies, they're very low right now, be it an auto company, cement company, you just go on. Everywhere capacity utilization is very low. We know that when the cycle turns and the demand sort of picks up, there's an operating leverage which kicks in. And we know interest rates are very high right now. And people can argue it will go down in 6 months, 1 year, but eventually interest rates are heading downwards. If you put these things together, what we can anticipate is that the EBITDA growth will be faster than the sales growth, and the profit growth will be faster than the EBITDA growth because of these reasons. Sort of a triangle formation. Historically, whenever you get these sort of triangle formations, those are the best time to invest in the market. So if you go back to 2003-04, I think 2004-05, I think the profits for the market grew at almost 35-40%. Beginning of the year, analysts use the standard model, which is 15% earnings growth. That's the occupational hazard. That's how they're trained. So, can I say 100% sure that it's going to happen next year? Probability is very high. Now, whether it happens from second quarter or third quarter, very tough to say. But we have everything in the making for a very good next few years, provided, and the fact that we also have a very good government right now. And if they just do enough, I think these valuations are misleading. That's the only point I can say.
But when you say government is a very good government, it's not proven itself yet, right?
Yeah, it's not proven itself, but at least they have, we've got a government which has absolute majority for the first time in almost, say, 20 years. We know from the style of the Prime Minister that at least at the state level he has done extremely well. So there is some bit of optimism. I also want to give some credit to the previous government. I know very many people have thrashed UPA, but in the last 18 months, they actually did a very good job, which completely went unnoticed or not enough credit was given. And some of the benefits of that, which happened in the last 18 months, is what this government is benefiting. They could have inherited a very poor balance sheet. Instead, they've inherited a balance sheet where the current account deficit was no longer a problem, the currency was stable. Some of the mess that they had created in the past, they tried to resolve, and they were at least halfway. So I think the ingredients for a recovery was already there in the making, and then you get a government which comes with an absolute majority. Unless they really screw up from here, the probability that we see a decent recovery as a result, we see strong earnings growth, and normally that's what results in stock performance.
Avinash, you look at India from a little bit sort of far away. Do you see it slightly differently because you have the luxury of, sitting in London and looking at how things happen in India?
You know, I think the first thing to say is that market's always right. Rule number one. Rule number two, if the market's wrong, refer to rule number one. So what does it mean? Yes, we are at, from historic perspective, at expensive valuations. So we are about one standard deviation away from last 20-year mean. As Sridhar and Nilesh said, you know, I think there's a lot of analysts are putting in some numbers. And just to give you, a colleague of mine did some mathematical analysis. The chances that an analyst is correct in his 5-year forecast is 1 in 3 billion, right? So much for analyst forecast. So what is the market pricing in? So let's look at that. I think what the market is saying is that there will be growth. We don't know when, but in the foreseeable future. Much more importantly, there'll be money to fund the growth.